Here is what most financial advisors don't say to you in person. Now, every dollar in your traditional 401 or IRA account carries a price tag you've never seen, and the government plans to bill you the moment you stop working. Unlikely, no doubt. What really bothers you is that most senior people have spent decades putting money into retirement accounts without realizing they were set up in tax traps. And now, in 2026, there is a closed window with rules, interest rates, and legislation lined up, giving you a real chance to reorganize things before math is bad for you. The video is about that window. If you are between 45 and 65, the content that follows is specific and time-sensitive, and each number comes from a law that is already in effect, or is in effect this year. The number that most people avoid seeing clearly is that the median retirement savings of people aged 45 to 54 in the United States are about $115,000, while the average is closer to $313,000, driven by high net worth outliers. According to Empower's latest 401 data, the median for people 55 to 64 climbed to about $271,000, with an average of $600,000 for people in their 50s. The numbers are not small. They represent real discipline, delayed spending, and sacrifice. For most Americans, the vast majority of this money lives in pretax accounts, traditional 401s, traditional IRA, SEP IRA, 403s. None of these accounts are taxed, which means that every dollar you withdraw when you retire is treated as ordinary income, the highest tax category in the tax code. Not capital gains, not dividends. The top of a ladder, that is where tensions are rising. You can't decide when to start withdrawing money. The government has created a mechanism called minimum allocation requirements to solve this problem for you. Under Security 2.0, if you were born before 1960, RMD starts at 73. Born in 1960 or later, he began shooting at age 75. It sounds like an extra runway, but more time just means more compound interest in your account, and you will eventually be forced to lose money, usually at the worst moment on your tax calendar. Imagine you are 74, and with Social Security, your traditional personal retirement account has grown to $800,000. The IRS now needs about $30,000 to $40,000 a year, which is superimposed directly on your Social Security benefits. Whether you need it or not, up to 85% of benefits will be taxed. Your Medicare premiums soared because of the so-called MR, monthly income-related adjustment. In 2026, once you earn more than $109,000 as a single filer, you will no longer pay a basic Part B premium of about $185 a month, a surcharge that could push your total Medicare cost to $628 or more per person per month. Mandatory withdrawals, taxable Social Security and IRMAA surcharges go into effect at the same time, which is how the tax time bomb actually explodes. The only way to stop it is to act before it erupts. The term tax arbitrage tends to conjure up complex financial instruments that only wealthy people with expensive advisors can use, but the concept itself is straightforward and perfectly legal. Congress plans to include it in the tax code, and they want you to use it. What they don't do is hand you a calendar with a red circle window. Tax arbitrage in the context of retirement accounts means that you intend to move money from a higher tax environment in the future to a lower tax environment in the present, and maintain the difference. Today, you pay taxes at a known rate, and you may face an unknown rate in the future, and then you transfer the money to a tax-exempt vehicle and distribute it permanently in the same way. The cars are Roth IRA and Roth 401. The tax framework matters, so to speak. The Tax Cuts and Jobs Act of 2017 set the tax rates that most people pay today, while the US Act, signed into law on the 4th of July, 2025, permanently locked it in brackets of 0.22%, 24% brackets. Such rates are historically low by any measure of American tax history. In the 1970s and 80s, the highest marginal interest rate was more than 50%. Today, the top federal interest rate is 37%, and most American workers earn well below that. When you retire and start withdrawing money from your pretax account, you will pay any ordinary income rate that exists at that time, and even if IRMAA maintains current interest rates, the pressure on nearly $37 trillion in Treasury bonds will not disappear with the legislation. Future Congress faces the same fiscal math. The risk of raising interest rates in 15 to 20 years is real, and the way to get money out of that risk is to shift the risk now. When interest rates are at known levels, there are currently 4 specific tools available, several of which have changed their terms in 2026, and most people over 45 have not yet fully registered. Standard catch-up contribution is the starting point. Age 50 or older, earning 401 or 403 income through your employer, you can pay a base limit of $24,500 in 2026, plus a supplementary contribution of $8,000, bringing your total income to $32,500 a year without current income tax. In the Irish Republican Army, the ceiling for 2026 is $7,000, and people 50 and older need $1,100 to catch up. So a total of $8,100. These numbers are not new, but many people in their 50s still fall short of the upper limit. Super catch-up is where things get really interesting. A word most people have never heard of. Under Secure 2.0, if you turn 60, 61, 62 or 63 in 2026, the maximum amount of additional contributions in your 401 account will jump from $8,000 to $11,250. In 2026, the total annual 401 contributions of these 4 age groups can reach $35,750. Once it reaches 64, the upper limit falls back to the standard catch-up amount. It is not a permanent feature of your financial life. It is a 4-year hallway that closes permanently behind you the moment you walk out. The Roth Catch-Up Directive added a layer in January 2026, surprising high-income earners. Secure 2.0 Section 603 now requires that if you are 50 or older and earned more than $145,000 from your employer in the previous year, your 401 must be a Roth contribution, which means after tax contributions, rather than before tax contributions. If you're a high-income person, whether you plan for them or not, and forced Roth contributions have already taken place, it is wise to combine them with a broader conversion strategy, rather than see it as trouble. Roth's transition window is the foundation of everything else. And for people in their 40s and early 60s, the opportunities are profound. Roth conversion is when you withdraw money from a traditional IRA or 401 account, pay ordinary income tax at the rate known today, and then transfer it to Roth IRA, where it is not taxed, compounded and taxed, no RMDs. There is no mandatory allocation. When you die, your heirs will inherit an account with no tax liability. The optimal transition window is between the point of decline in income at retirement and the point of complete convergence of RMD, Social Security, and other sources of income, aged 73 to 75. For most people, the gap lasts 7 to 10 years, and financial planners call it a golden window because of how much lifetime tax savings it can generate if used properly. At 45, he plans to retire at 60, about 15 years before the window is fully open, which means laying the groundwork now to begin the transition in the first year of reduced income. The math problem is worth trying. Exchange $50,000 a year from a traditional personal retirement account at 22% for a decade, during which you pay about $110,000 in taxes. You get $500,000 worth of principal, plus all future increases. that are never covered by ordinary income taxes, RMDs and IRMAA surcharges. If that $500,000 rises to $1.2 million at age 75, then $700,000 in earnings is not taxed at all, compared with the traditional IRA scenario, in which a 75-year-old mandatory RMD requires $45,000 to $60,000 a year, each dollar taxed as income. Understanding these tools is only half the equation. Going too fast or too far in a year can trigger the cost of directly eroding returns. So let's list the 3 biggest traps and explain exactly how each works. IRMAA is a trap no one sees. In 2026, the standard Medicare Part B premium was about $185 a month, a figure most people expect to pay when they reach Medicare age. But IRMAA puts income-based surcharges on top of that base, which will take effect in 2026 when your revised adjusted total income is settled as a single filer of $109,000, or when married couples file a joint declaration. At the highest level, a married couple faces nearly $4,600 a year in additional Medicare costs per person from IRMAA alone. What makes this especially dangerous is the 2-year review rule. Your 2026 Medicare premium is based on your 2024 income. A large-scale, ill-timed Roth conversion in 2024 produced higher Medicare bills 2 years later, which could not be reversed. The conversion plan must be carried out in precise annual increments, keeping revenue under each IRMAA cliff. Rather than blowing it over, widows face slower and more damaging tax penalties. When a spouse dies, survivors lose the most favorable tax status in the United States Code, Married Joint Declaration. In 2026, the standard deduction for couples reporting together was $32,200, while the deduction for a single filer dropped to $16,100. The 22% tax rate for single applicants ranges from $50,401 in taxable income to more than $94,000 for married couples. A couple totaling $120,000, including the RMD, can sit in 12% brackets as joint filers. One spouse died, income remains unchanged. But living spouses who apply to be single are well pushed into the 22% or 24% range, face lower standard deductions, and often cross the IRMAA threshold at the same time. The only protection is to reduce the pretax account if both spouses are alive, and use the joint grade tax rate to exchange dollars, which would otherwise be taxed at the single filer tax rate. The RMD avalanche is the result of waiting. Many plan to make small withdrawals after retirement and keep their tax rates low, which can work until RMD arrives, and the choice is completely withdrawn. According to the IRS actuarial table, a traditional IRA of $1 million at age 75 generates about $43,000 in the first year. By age 80, the same account forced withdrawals of nearly $53,000. If the account continues to grow in the years leading up to the start of RMDs, due to good market performance and small withdrawals, the required distribution ratio will increase, usually pushing revenue to a higher level and IRMAA at the same time. The only protection against this sequence is to withdraw funds from pre-tax accounts in brackets under your control on your own schedule before mandatory withdrawals begin. All of this becomes clearer in a specific scene. So meet David and Karen. Both were 52. David earned $175,000 in corporate management, and Karen earned $35,000 part-time. Between David's traditional $401,000 of $580,000 and Karen's traditional IRA of $140,000, they have a pre-tax retirement exposure of $720,000. Both plan to retire at age 62, giving them a 10-year window before starting RMD at age 75. Because they were both born in the early 1970s, path looks familiar. They continue to pay pre-tax contributions and retire at 62, allowing their accounts to grow without any conversion activity, with an annual growth rate of 6%, their combined traditional balance could reach about $1.6 million by age 75. The first year, RMDs will mandate about $67,000, plus about $48,000 a year in comprehensive Social Security income, bringing the couple's total taxable income to about $115,000. This is manageable as a couple filing documents together, but after David's death, where did the damage accumulate? Karen inherited the entire IRA balance, assumed full responsibility for the RMD, and filed as a single filer. For the couple, the same income is comfortable, now pushing Karen into the 24% range. Her standard deduction was cut in half. IRMAA surcharges climbed. Her effective tax rate when she retired ended up significantly higher than any of the taxes they paid while working. From now on, David and Karen convert $30,000 to $50,000 a year from Karen's traditional IRA to Roth's, carefully remaining in 22% of the joint braces each year, to observe the IRMAA threshold to avoid accidentally crossing the cliff. When David turns 60 in 2034, he qualifies for Super Catch-Up, paying $35,750 a year, directly to Roth's 401, where his employer provides one to match the ongoing IRA conversion. By age 75, much of their pre-tax exposure had been transferred to Mr. Roth's account. Their RMD account balance is small. Social Security is unlikely to be fully taxable. IRMAA exposure remained low. When David finally passed, the widow's tax penalty fell to a much smaller pre-tax target, because most of their wealth was already in accounts with no ordinary income tax consequences. The lifetime tax gap between the two paths runs through any standard financial planning model, depending on the size of the account and the specific brackets, ranging from $180,000 to $350,000. This number is not a rounding error. For most people in their 50s, the difference lies in the difference between comfortable retirement and stressful retirement. Let's get straight to the schedule, because that is where many people slow down and decide to talk about it later. IRMAA made the TCJA rate permanent, eliminating sunset deadline pressures in 2024 and 2025. That led to a scramble for a conversion window, but permanence in the tax code means until Congress changes it, and the pressure of nearly $37 trillion in Treasury bonds will not disappear with a piece of legislation. Future Congress faces the same fiscal math. The structural argument for raising interest rates in 15 to 20 years is not based on political forecasts. It is based on arithmetic. The window was also closed for biological reasons, not just legislative ones. Now 45. RMDs and Social Security are completely concentrated on your income, about 20 to 28 years. Each year's inaction intensifies in another year, which exists in the pre-tax account, increasing the eventual mandatory withdrawal. At 55, the runway was shortened to 18 to 20 years, a transition that needs to start now, not in 5 more pressing years. For people now 60 to 63, the super catch up corridor now opens at age 64 and closes permanently, sitting at age 63 this year. Without all the super catch-ups, means leaving $3,250 in additional tax breaks on the table and never coming back. For couples who are both living and in their 60s, each Roth conversion at the consolidated bracket rate is now $1, and when one of them eventually dies, it will not be taxed at the higher single filer rate. This is not an abstract worry about the future. This is a calculation with known results, and the only variable is how much pre-tax exposure was transferred before the reporting status changed. The United States Tax Code issued no warning It collects any debt you owe, based on your choices. And for most people, over 45, the actual tax efficiency of deciding to retire is not made at retirement. They are now living in an era where incomes are still flexible. The choice between pretax and Roth still exists, and the spread between current and projected future interest rates creates a real, usable gap. Accounts are the mechanism. Timing is the window. The difference between what you might owe and what you actually pay is opportunity. What you need to do now, not next year or after you've sorted out other things, is clearly calculate the total risk of retiring before tax. Every dollar in every traditional account, the balance is expected to be 73 or 75, and no additional action is required. Calculate the first year's RMD, superimposed on Social Security. Check the level you entered as a joint filer and a single filer, because both numbers are important. On this basis, determine how much can be redeemed annually without exceeding the IRMAA threshold, while maintaining a range of 22% or 24%. Build a 10-year roadmap. Start moving money from taxable to tax-free barrels to maximize each applicable catch-up contribution. And if you are 60 to 63 now, consider using SuperCatch as an accelerator, because some doors close only once. It took you years to build your nest. The only decision is how much you can keep. If the video helps you see something you haven't thought about before, click the like button. It helps the channel reach more people who need it. If you want to stay ahead, subscribe, because more rule changes are already in progress. And in a comment below, tell me how old you are and whether you are currently running any Roth conversion strategies. Each will be read. See you next time.